And probably the number one piece of advice that I would give to early stage founders is keep your team small. Keep your team small, not necessarily for as long as possible, but for until you find true, undeniable product market fit.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Pablo Srugo with us. Pablo is a partner at Mistral, investing in seed stage startups. Prior to Mistral, Pablo was the co founder and COO of Gymtrack, a VC backed startup in the FitTech space. Pablo also hosts the Product Market Fit show, where he discusses how popular companies found product market fit. In this episode, we talk about how Pablo almost became a millionaire by 25, but instead went bankrupt. How he helps companies find real product market fit and not fake growth numbers. What are the 5 steps to product market fit? Importance of staying lean until product market fit is achieved. How should startups navigate the increased focus on profitability? And lots more. So, without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Pablo, so good to have you on the VC10X podcast. How are you doing?
Good, Prashant. Great to be here.
Yeah, it's a pleasure having you on. To start things off, can we first have your background story to start with?
Yeah, I'll tell you, high level. So I'm a founder turned VC. I started off, actually studied economics in university, and then in my final year started tutoring kind of on the side, like kind of freelance. And I had a friend, Lee, who he and I kind of worked on different business plans. We really wanted to, frankly, start a startup as many people at kind of 19, 20 years old want to do. And we played around with a bunch of different ideas, but frankly, our bachelor kind of 4 year degree was coming to an end, and we didn't have any great ideas that we wanted to run with. And so, like I said, I was tutoring on the side, and so I went to Lee and said, listen, why don't we just create kind of a tutoring marketplace, or at least like a tech enabled tutoring company, and just expand on this. And that's what we did. We hired about 30 tutors across kind of the universities in Ottawa, which is where we lived, and launched my tutor. And so we ran that for about a year. We ended up selling the business and then starting a venture backed startup called Gymtrack. I mean, the reality is my tutor didn't take that long to run, like on a weekly basis. It was really just answering calls and setting it up with tutors. And we would spend the rest of the time, we lived together, spend the rest of the time just brainstorming ideas. Whether that's the right move or not is a separate question, but that's what we did. And one of those ideas ended up being Gymtrack, which this is back in 2013, 2014, kind of before the Apple Watch. Samsung Gear had just come out. Fitbit was still kind of super hot, and we were seeing all these Kickstarter projects, Indiegogo projects, kind of crowdfunding their way to 200K, $500,000 by promising people to track the reps in the gym. And so we decided, well, instead of going direct to consumer, what if we went B2B? What if we went to gyms, to businesses, and offered a system that would let their members automatically track their workouts? And so that's what we did. We launched Gymtrack. we ended up going through 500 Startups Accelerator in SF. We ended up raising about $6 million through that whole journey, and frankly spending it building a team of engineers to develop the product, right? To actually make the tech work to the level that we needed it to, and frankly didn't get there. I mean, the kind of goalpost kept moving. We really hit diminishing returns. Hardware is hard. That's it's a cliche, but it's real. And so that was kind of the Gymtrack story, in a nutshell. And again, I can dive deep into many parts of that.
Right.
And then after that, frankly, when I left, at one point we hired a new kind of professional CEO, so I worked with him for a couple of years. And then when I uh, when I left to start something new, that's when I was introduced to the founders of Mistral, the seed stage firm where I'm now a partner. And after a few conversations, decided to join. So that was kind of mid 2018, and yeah, really, haven't looked back since. It's been a great ride so far.
Right, totally. That's a very interesting journey. And tell us a story of how you almost became a millionaire by the age of 25, but instead went bankrupt. What happened there?
Yeah, so happy to share that. I wrote a Medium post about this, and then have a podcast episode on my podcast, the Product Market Fit Show, about it. But I'll give you maybe the summary story here. So what happened was, through Gym Track, in the very early days when we had gone through 500 startups and started kind of raising our seed round, there was an equipment manufacturer. Kind of, if you think about the equipment in a gym, there's kind of three or four big brands, and so one of those came to us and said, "Listen, like we want to do some some things in the venture space. We really love what you guys are building. We'd love to invest." And just so happened they came a little late. We'd already kind of done a lot of work with a handful of VCs, and didn't want to start a new process. So after some thinking, we ended up telling them, we just we can't do it. We're already going to take this other term sheet. Sorry. And so that kind of went away. We raised our first seed round. And then as we kept moving, literally like in the next month or two, they came back and said, okay, you know what? If you guys, fine, you didn't want us to lead the seed, what about the Series A? Why don't we just do Series A now? And so we get super excited about this. Obviously, we're like 21 years old, people just, throwing money at us, sort of thing. At least that's the feeling. And we engage, right? And we kind of go through a process with them. But what happened was, through that process, that they wanted certain like control terms that our board, didn't agree to. And so we kind of went back and said, listen, we just can't do it. Like, at the end of the day, if you want to control this company, you'll have to buy it. And we kind of threw that out there, thinking that would be the end of the conversation, and it wasn't. They kind of came back and said, "Okay, you know what? If that's what it's going to be, that's what it's going to be. Let's start an M&A process." Um, and now, as that kind of starts going down, kind of progressing, where I was probably 23 or so, and you start getting in your head about, wow, like, what am I going to do with all that money? What am I going to buy? Like, which car am I going to get? Like, it just, as it gets more and more real. And I remember, at one point, really kind of as a sanity check, going to our lawyer and asking him and saying, "Hey, Shane, how many?" Because we'd gone really far. Like, we had signed a term sheet, we had, paper, like full kind of purchase agreement was drafted, employment agreements were drafted, a lot of negotiation back and forth, months of negotiation, and a lot of legal fees. And so I said, "Shane, like, how often do deals get this far, but kind of fall through?" And he's like, "Honestly, 99% of deals that make it this far happen, right? End up getting consummated." And we were the 1%. So, ultimately the deal kind of falls apart, and we're left with, kind of nothing, because what had happened through that time is we were burning about $250,000 a month, and we were running down our balance sheet, right? We hadn't raised that much money, and so at some point we had like 4 months of runway left, and we hadn't made any structural changes, because as we're going through this process, they were buying us partially for our team. And so we didn't want to make any kind of hasty decisions and alarm anyone. Um, and they were going to infuse money into the company after the process. So there was kind of no reason to. But then when that fell through, all of a sudden we went from, feeling like we were millionaires to having to lay off, 2/3 of the staff. And that's when we hired the new, the professional CEO, and he took the company in a different direction. But V1 of Gym Track, right? The idea of tracking members in the gym kind of died that day, and that's why, that's why I kind of summarized it as supposed to be a millionaire, when instead, and the company did ultimately fail.
Totally, that's a crazy story there, and a key lesson there also, which I've also learned the hard way, and I think you learned the hardest way possible because I run a business, and I mostly do deals for my business, which are not as high ticket as an M&A transaction, obviously, but I've had that. I was getting happy at conversations getting further, and getting to a stage where a deal is about to close. Right, I was kind of happy about it, but now I've gotten to a stage where I know that a deal is not done until the money is in your bank. Right, so I honestly now don't care at all how further a deal gets in the process, and I don't celebrate it at all. I'm emotionless to it unless the money's in my bank, right? So I think you learned it the hardest way possible for an M&A transaction, but yeah, that's a lesson
Yeah,
there
100%.
for
I mean, it's tough,
yeah,
right? Because like that's the world of being a founder. Frankly, is like the highest to highs, the lowest to lows, and partially you
right.
get on that roller coaster and you ride it. And you, as much as you want to be stoic about it, I think it's really hard to do that. And you're gonna feel you're gonna feel the highs, you're gonna feel the lows. You've got to ground
Right.
yourself, and I think with experience and age, that definitely helps. But at the end of the day, it's something very human to kind of have these feelings of anticipation, and uh, and it's really hard to turn that off.
Yeah, totally. And you as a person have a lot of focus on product market fit. You run a podcast that's called the Product Market Fit Show. I encourage our listeners to go check that out. And also, that's also a key focus at Mistral, right? So tell us how you are helping your portfolio companies and helping them find real product market fit and not fake growth numbers, right?
Yeah, it's a great question. I mean, at the end of the day, the way we think about it is, there's before product market fit and there's after product market fit. And after product market fit, there's a lot of things that start to matter, right? Culture starts to matter in a big way. How much funding you have, matters in a big way. Uh, Operational excellence and planning and finance, all these other functions that when you think about a classic enterprise like a corporation, these are the sort of pieces of the puzzle, right? And great corporations are honestly great at all these things. And if you look at public companies and you hear quarterly calls, these are the sort of things that they're going to talk about, right? Long term strategy, etc. And but there is that kind of fine line before that divides product market fit and non product market fit. And before product market fit, frankly, none of this stuff matters. I mean, it just doesn't matter. The only thing that matters is getting to product market fit. If you get to product market fit, you now get to a place where you like you're almost like you're an experiment until you get to product market fit. And when you get product market fit, you're now in a stage where all the other things can actually add value. And so that's the way that we think about it. It's really the 0 to 1 sort of event. And frankly, it is a bit more of a spectrum, and product market fit is on every single feature. But there is this real concept of this before and this after. And we focus all of our time on the before because we work, I mean, almost all of our time on the before because we work with early stage companies and kind of help them in that path. Now, I'll admit, and I'll be the first one to admit it, like VCs, as much value as they can add, are maybe 1% of the equation, right? The founders and the teams are 99% for the simple reason that they have way more depth. They're involved 80 hours a week, versus our 2 to 5 hours a week, right? So it's never going to compare. I think what we can do is what we add to the equation is that we have breadth, right? Like we have seen way more examples of companies, of founders than any given founder has. And even a repeat founder, right? Like, or even a repeat founder has really experienced deeply their 2 or 3 experiences, maybe spoken to a few other founders, but we have seen hundreds. And so we can start to at least get a sense for like pattern recognition of the sort of things that are likely to help you find product market fit and the sort of things that are likely to kind of lead you astray.
Totally agreed. VCs do see a lot of game film, and that gives them that bird's eye view of what works and what doesn't work in regards to product market fit, right? Uh, and when you say you know what works and what doesn't work, can you give us a brief insight into that? That what actually works? What's a good mindset to think about product market fit for early stage founders?
Yeah, I can. And it'll be at a high level because the only way to get specific is on case by case, right? But what I can tell you is, I'll give you one concrete, uh, let's say, tip or whatever, which is, and probably the number one piece of advice that I would give to early stage founders is keep your team small. Keep your team small, not necessarily for as long as possible, but for until you find true undeniable product market fit. Until you have clear market pull, don't grow your team, because it's much easier to find product market fit with 5 to 10 people than it is with 20 or 30. When you start getting into the 20 or 30 range, you now have to spend time aligning your team, communicating with your team, managing your team, having sprints and planning phases. Every single time you want to make a change, you have to explain it to 20 or 30 people. You have to get buy in from 20 or 30 people. And that's not helpful when you don't actually know what the thing is. By definition, if you don't have PMF, you haven't found the thing. So all the stuff that you're building is experimental, right? And until it becomes proven because of that market pull, you can't really add more bodies to solve the problem. What you have to optimize for is experimentation, it's velocity, it's the ability to change quickly on a dime, right? So when you have 5 or 10 people, let's think about five, right? And I have so many examples. Like you look at Clio, this is how it was. You look at Shopify, this is how it was. Spellbook, another one that was in the in the headlines lately because of AI. That's how it was. And what these companies were really good at was was experimentation really quickly, trying things really quickly, and moving and shifting and being extremely close to the customer. That's another thing, is that when you have more bodies, you actually get further and further away from the customer, right? As a founder, which is the last thing you want, especially in those early days. So that would be my number one piece of advice, is like when you're searching for product market fit, it's not just a runway thing, by the way. It's not like, well, I've raised $5 million, so I have all this runway, so I can add more people. I'm saying that adding more people beyond 5 and 10 before product market fit will, in almost all cases, there's exceptions to everything, but in almost all cases, make it harder for you to hit true PMF.
Yeah, that's a very solid insight there, and also an advice for founders based on true events and true startups that you mentioned, right? And you have talked to a lot of successful founders who are now post PMF, who have achieved product market fit on your podcast. What has been a common thread there? Is it similar to what you suggested? That's one aspect of it, of course, keeping it lean initially. But any other aspects that you can share that you've learned from other founders on your podcast?
I think like a maniacal focus. First of all, actually, just being focused in general is a key trait, but focus especially on value delivery, value creation, right? Less so on what happens a lot now, because like the entrepreneurship culture is is kind of like entrepreneurship has really permeated the culture, I should say, and so many people are wanting to be founders, wanting to be entrepreneurs. There's so much information out there that one of the downsides actually is almost like overthinking, over strategizing, uh, over polishing a deck and a story and a narrative. Because the reality is that like the more that time you spend on a narrative, at some point, at the beginning, you help yourself understand the world, and at some point, you go from helping yourself understand the world to just convincing yourself of a worldview that may or may not be real, and that actually is not helpful. And so, that's actually a core difference I see between I talk to a lot of founders, obviously, who pitch me or conversations that I have that are not, let's say, yet successful. So that's kind of your baseline, right? And then I interview founders that have gone into like late stage, well beyond product market fit. In many cases, had exit events or became unicorns, and that's kind of your success. Let's say it's your successful bucket of founders, right? And one difference I find is like if you look at the early days of a lot of these companies, there was no strategic vision in most cases, right? Like I'm about to release an episode on Snapchat, there was no thesis about mobile or the App Store in the creation of Snapchat. There was no huge vision around e commerce in the creation of Shopify. In most of these cases, what it was just somebody figuring out how to deliver true value to a specific customer set today, and it's the sort of value that was really kind of a top number one or number two priority problem for that ICP, for that ideal customer profile. That's one of the things. And the maniacal focus on doing it. Some people got it right away, right? So I spoke with like Fullscript. They're doing like $900 million in revenue. When they put out what was basically like Shopify for naturopaths, it took off right away. It just hit right away. They got 50% of the Canadian market in like a year. In other cases, like with Spellbook, right, they just raised like a $27 million Series A, but it took a long time. It took actually years of experimentation, hundreds of landing pages until they found the right kind of problem solution set, right? The right, not just phrasing, but the right problem to go after, the right way to tackle the problem, right? They always wanted to streamline legal firms, but they attacked it in so many different ways until one really hit, which is kind of this chat GPT for lawyers that they're doing today. So many different ways to get there. But at the end of the day, the core focus on just finding a way to deliver true undeniable value as kind of the key um, North Star, I think, for all these companies in the pre-product market fit phase.
Right, totally. And you mentioned earlier in the conversation how when founders raise money, raise a round, they think, okay, I'm going to spend it and I'm going to hire a bigger team. I'm going to get more people in the team and then attack it, then attack the PMF problem, right? You're saying that that's not the right approach. You should keep it lean initially. Then what do you suggest that money should be spent on?
Well, that's kind of the interesting piece. I mean, and again, there's going to be exceptions, right? So I did an episode with Glean. They're like a $2 billion company today. They started off with like a $20 million round right away, but the founder had been through it before. He knew what he was doing. It was a different problem set. So, but we're going to call that like the 1% of the 1% that are successful startups, right? The 99% of successful startups, that stuff, more money, more bodies leads to more activity, more production, more features, but not to more success because it actually doesn't get you any closer to PMF. So I think for most founders, like you, at the end of the day, if money's on the table, like let's say somebody, we're in 2021, 2022, and they're like, hey, here's $5 million and 50 million value. Should you not take it? I mean, you'd be crazy not to take it. If I was a founder, I would take it. The difference is what do you do with it? And I have seen founders, Rob, for example, he runs a company called Float in Toronto. He raised a pretty big round in kind of those heydays, and he just didn't spend it. Like he just kept it, right? So if you have the discipline to do that, then by all means you should do it. If somebody gives you money on stupid terms and you're the recipient of that, you'd be a fool not to act on it. The difference is, do you all of a sudden start to grow that team, start to grow your expenses just because you have the money? That's your mistake, right? And that's the part that I'm really talking about. But I think for most founders, you rarely get like stupid terms. So I think what it really means is uh, you just don't need that much money to find product market fit. What you need to build are a team of 5 to 10 people that either are founders or founder like. They're builders, right? They need zero management. And they're what you need, depending on your use case, depending on what you're building, to just iterate on different concepts and try out different messaging as fast as humanly possible, right? Until you start to feel that market pull. And then when you do, that's when you can kind of start to lean in.
Right, totally. And up until what stage are startups expected to achieve product market fit?
Sorry, what do you mean?
So I mean the fundraising stage. So there is a pre-seed stage, there's a seed stage, there's a Series A stage. At what stage are startups expected to have achieved product market fit?
I see. Yeah. So classically, that would be like Series A. I mean, the way we think about it is pre-seed is kind of team market fit, team going after some idea, some market. Uh, Seed is proven value prop. So like the team is actually delivered a product to a subset of customers who's actually getting some value from it. And then Series A is clear product market fit, which is the value creation is so clear and resonates so well with the ICP, the ideal customer profile, that there's just clear kind of market pull as a result of that, which shows up in high NPS scores, high retention, maybe high growth. There's a bunch of depending on the product, there's a bunch of different metrics you can look at. But it's also a feeling, frankly, it's also an emotional feeling that when you talk to customers, they're like, I could not live without this product.
Yeah, totally. And you mentioned on the fundraising fund, if you are able to get amazing terms, you can potentially take it and keep it and not spend it. Because I think what most founders get wrong is they think that since they have the money, they need to spend it, right? But actually, your number of people in your team is not a KPI or a metric that you're chasing. It's actually growth numbers, right? So if it's optimizing those growth numbers and you're achieving a real product market fit, not just burning money to acquire users, right? Then you should probably spend it. Otherwise, you should just keep it if you're getting it on lucrative terms, right? Awesome. And there's one thing that you prepared, maybe a presentation or something that you've been presenting at different conferences, which is called the 5 steps to product market fit, right? Uh, can you allow our listeners an insight into that?
So yeah, I'm happy to give you, like the presentation itself is like 20 minutes or so. So I won't go through like all the details, and really, I think the richness comes from a lot of the examples, but I'll walk you through kind of 5 steps, at least at a high level, right? So step one is really about finding real problems. And the kind of catch line there is, before startup mode, there's research mode. So before you even have a startup and can do like lean startup things, right? Like Eric Ries and all that kind of good stuff, you actually have to do serious research. And I've seen this done in a bunch of different ways. One of the clearest examples I like to use is this company called Ada, which is a chatbot company from like the 2010s. But the way that they built the product is they actually became customer service agents themselves. The founders were customer service agents themselves for over a year, doing the actual job and figuring out all the subtleties, all the different workflows, all the different pieces of the puzzle. And then they automated themselves out of a job. And that became Ada, which is now a unicorn. And so that's step one, is like, before startup mode, there's research mode. The second one is that, there's this book by Andy Grove, the ex-CEO of Intel, called Only the Paranoid Survive. And I think that what translates over when you think about pre-product market fit is that only the insanely focused survive. It's pretty crazy when I talk to some of these successful founders, the sort of weird things that they were doing early on that only someone with maniacal focus would do. As an example, a company called Wealthsimple Canada, it's a $5 billion company, has millions of users. It's kind of like it's not Robinhood, but it's a finance app. And Mike Katchen told me when he started, he would call every user. These are not paying subscribers. These are not businesses. But every single time he get a sign up, he would personally call them within 30 seconds of signing up, just to ask them, how the experience was and just to introduce himself. So that's like, when you're so focused on satisfying customers, that, and that was his focus. Those are the crazy things you do. And so that's step two, is like, only the insanely focused survive. Step three is, you have to be in the market to win the market. And what that means is you kind of have to start somewhere. Like, we have all these like there's so much focus on market size, TAM analysis from the outside looking in. But the reality is, these things get found from the inside, right? You have to actually be in the market to win the market. And you don't really know where things are going to lead you once you're there. Like, once you've identified a high level problem and you get insanely focused, you actually have to get in. And there's just so many examples of this, right? Like Wattpad is is one, right? They have 100 million users now on their marketplace, but it started off like in the pre-iPhone age, like in the flip phone age, and it was literally an app. Today is like an app where authors can write books and readers can read them, right? And it's one of the biggest marketplaces in the world for that use case. But it started off as literally an app to help people read stories on their phones, like classic stories on the go. Like, that's what it was. There was no market, like there was nothing really there. There was no TAM analysis. But he was in the market, right? And he had found a problem that was a real problem for him and some subset of people. And that led to something, which led to something else, which grew the marketplace, which grew users, and so on and so forth. So you have to be in the market to win the market. That's more your classic kind of lean startup thing. Step four is forget growth, find value, right? So I think post product market fit, you want to engineer growth. Like, you want to spend on sales, you want to spend on marketing, you want to spend on product, all as a function of what's going to grow top line, what's going to grow customers, right? Whereas before product market fit, you're really not looking for growth, you're just looking for value. And that can mean weird things, like in Clio, which is a legal tech startup out of Vancouver, $1 billion company. His example was, when he started, he actually made it hard for people to join his beta program. He added friction. He said, if you want to be in my beta, you have to go through this webinar, 30-minute webinar. That's adding friction. Like, that's the opposite of what you'd want to do post product market fit, where all you want to do is remove friction, make it as frictionless as possible. But his goal wasn't to grow. It wasn't to get as many beta customers as possible. It was to get the right beta customers so that he could have the right conversations and find value. So that's step four. And then the final step, step five, is pivot harder, faster, right? Like, the reality is, even if you go through all these steps, even if you found problems, you get focused, you get in the market, and you search strictly for value, you have to be willing to look at everything that you've done up till now as a sunk cost. This is maybe one of the hardest things for founders to do, because founders are builders, and when you build something, you get enamored with it, and there's this kind of sunk cost fallacy, or this endowment effect that comes into play, all these biases that make you overvalue what you've already built. But the best founders are willing to understand this simple truth, which is if you're pre-product market fit, by definition, you haven't found the thing. And if you want to go to the extremes, what you've built so far is like worthless. It's not actually worthless, but that's probably a better construct than anything else, which is I haven't found product market fit. So all the stuff I built so far isn't the thing. So it's not worth that much, which means that if tomorrow there's a new thing, still probably within your market, within the world you understand, right? Within your ICP, that's the thing we should go out and we should be willing to kind of forego everything else. In fact, what one founder told me, the founder of Spellbook, Scott, who'd done like hundreds of landing pages, he said, if anything, I would have been more aggressive. And anytime I put out a new feature, I would have presented it as an entirely new product with a new name, new branding, new landing page to not confuse potential customers with everything else that I'd built, not try to think about how does this fit in and how does this position, but to kind of start with a blank slate and give that new messaging the best chances of actually resonating. So that's step 5 is pivot harder, faster. So those are all the steps um, that kind of, and these have been pulled frankly from all the conversations that I've had, mainly through the product market fit show on all these companies that have achieved product market fit.
Right. That's super insightful for our listeners there. These days, there's an increased focus on profitability and sustainability in startups, right? How do you suggest founders navigate that?
Well, I think this is it's a positive change because at the end of the day, if you're running your company with this kind of growth at all cost mindset, um, it, you're putting yourself as a founder in a very risky kind of predicament where if everything works out, yeah, you can be huge, but if you stumble at all along the way, you can get a big fat donut, right? It can end with a big zero. And I seen many companies that have like otherwise decent companies. Maybe they're doing 3 million, 5 million, 8 million in revenue. But because they've raised so much money, the founders are under the stack, right? Which means, like, for example, if you raise $30 million, that $30 million is going to get paid out first. So if you sell your company for 30 million, you get zero. If you sell it for 31, you split the one with whoever else is a common shareholder. And so if you think about it, like if you build a company of $5 million and you own 20%, and maybe now this company's not growing as fast, right? That's the thing that'll happen often is growth will slow down. And regardless of what you try, maybe you've hit the market size, maybe you didn't have the product market fit you thought you had, maybe the competitive landscape's changed. There's so many reasons. Companies stall at 1 million, at 5 million, at 10 million, at 20. Like you're never safe, right? And so the point is, once you stall and your growth rate stalls, your multiples get extremely compressed. I mean, if you are doing 2 million in revenue and doubling, you could be worth 20, 30 million. If you're got 5 million in revenue and only growing 10%, you might only be worth 10, 15 million, right? And so this is where things get tricky. Now, if you've raised a lot of money, if you've gone growth at all costs, and all of a sudden this starts to happen, you're stuck because the price for which you could sell your company means you end up with nothing as the founder. And you can't grow your company because you're trying to and it's not working. You're stuck between a rock and a hard place. You have no good options. And so this is kind of goes to the concept of positioning, which is this idea that it's not about predicting the future. It's just about putting yourself in a place where all your options are good, right? If you raise too much and you grow too fast and things don't work out, you've set yourself up in poor positioning where all of your options are bad. If you've stayed lean and growth slows down, then because of your positioning, you now have options. Maybe you keep running a company and it's profitable because guess what? You don't have 80 employees with 5 million in revenue. You've got 25. So maybe it's a profitable business. Maybe you sell your company because even though you can only get $15 million for it, you own 20%, 30%, you've only raised a few million. So guess what? You can actually make many millions of dollars by selling that company. So you have all these options available to you as a result of staying lean. And that's why that's just a better, I think, method for the vast majority of companies. There's exceptions, look at Uber, like would they have worked out if they'd stayed lean? Probably not. I mean, there's companies that actually, play out like that. PayPal is another example. If you look at the early days of PayPal, like they were, there was fraud issues. There was so many things. They spent so much money and it worked out. Huge business. But those are the exceptions. Even within the successful group, those are still the exceptions rather than the rule. And so I think that's just a better methodology for most founders.
Awesome. And this one thing that founders obsess about, or maybe the media has created that, where founders obsess about becoming a unicorn, right? Which is somewhat also a good outcome for founders and also a good outcome for VCs, because obviously a big outcome for portfolio companies means a big outcome for the VC. But you hold a view that that should not be the only thing that founders should be aiming at becoming a unicorn. It should not be something that they should be obsessing over, right? So, why do you have that belief? Tell us more about that.
Well, to be clear, I'm not saying that aiming to become a unicorn is a bad thing. I'm just saying that it's not the only thing. And it can be a bad thing if you do it too early. If you're a proven founder, you've been through it, you understand the game, then, you want to go for it, go for it. If you have clear product market fit, you're in the market, you can actually feel the pull from your customers and you want to go for it, go for it. And by the way, as a VC, those are the types of companies that we work with exclusively. Like we only work with the companies that really want to go for it. My point is, if you're neither of those, especially if you're a first time founder, and especially if you're very early and you actually don't know what the opportunity really is, because I'm telling you right now, no Gartner report, no deck, none of that stuff is really going to tell you what's the real opportunity. The only way you're going to find out what the real opportunity is through actually having a product and customers and demand and feeling it, right? And so if you don't have those things and you are already thinking about, I'm going to be create $1 billion company, and you instrument your whole company about that, and you put yourself in this unicorn or bust framework, again, go back to what we were just talking about. I don't think you're optimizing for yourself to succeed. And I don't think many founders realize that it's probably a lot easier to make $10 million by building a lean, maybe bootstrap, maybe raised a few $1 million startup than by building a unicorn. So it just depends on your goals. That's all I'm saying. Like there's none wrong with going for it, building $100 million business. And again, like that's where I play, that's where I work. Those are the founders that I partner with. I'm just saying that that's maybe the right fit for 5% of opportunities. The other 95% are in no means less. There's just different opportunities, and they require a different financing model and a different vision of an outcome.
Awesome, Pablo. Now, to close this out, let's do the rapid fire round wherein I'll ask you 5 quick questions about the investing you're doing at Mistral, and you have to give 5 quick answers. Sounds good.
Perfect.
Awesome. First one is, what are the sectors and regions you invest in?
So we invest across verticals, across sectors, mainly in Canada and the US.
Awesome. What's the typical stage of investment?
We invest at seed more than anything.
Typical check size?
$1 million.
Where can founders apply for funding in case there's a direct way?
I think you can reach out to me on LinkedIn or through email.
Awesome. Last one, where can our listeners follow you?
So follow me on LinkedIn and check out the podcast, The Product Market Fit Show.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for making time for this, Pablo, and it's been a really insightful episode. Thank you.
Thanks, Prashant, for having me on.
Thank you so much.